If you had invested $10,000 in the S&P 500 in 2010, you would have over $60,000 today, doing absolutely nothing. So what is the S&P 500, and how do regular people actually invest in it? That's exactly what this video covers. Think of the S&P 500 as a giant basket holding shares of 500 of the largest public companies in America. It is not a single stock or something you can buy directly. Instead, it is a list, a running tally of which companies are in that basket and how much each one counts toward the total. When people ask what the S&P 500 is, they are describing that basket and the companies inside it, not an actual product you can pick up off the shelf. Inside this basket, you will find names you recognize: Apple, Microsoft, Amazon, Alphabet, Visa, and Johnson & Johnson. In fact, these 6 alone make up about 30% of the basket's total value. But the full list covers companies from every corner of the economy: tech, healthcare, finance, consumer goods, and more. Together, the S&P 500 represents roughly 80% of the total value of all U.S. stocks. That is why so many people use it as a shorthand for the market itself. You cannot buy the S&P 500 directly, but you can invest in it through an index fund or an ETF. These funds are built to copy the basket exactly, owning the same companies in the same proportions. When you buy a share of a fund like VOO or FAIX, you are buying a tiny slice of every company in the S&P 500 at once. That is what makes index fund investing so popular, especially for beginners. Instead of trying to pick winning stocks, you own a piece of the whole market. Warren Buffett himself has said, put 90% of your money in a low-cost S&P 500 index fund. For most people, that is the simplest way to start investing and build wealth over time. The S&P 500 index matters because it covers about 80% of the total value of all United States stocks. When you hear people talk about the market, they are usually pointing to this index as the scorecard. Over the long term, the S&P 500 has delivered an average return of roughly 10% per year before inflation, about 7% after you factor in rising prices. That is not a guarantee for any single year, but over decades, this steady growth is what has made it the backbone of retirement plans, college funds, and everyday investing. Warren Buffett, one of the most famous investors alive, puts it simply: put 90% of your money in a low-cost S&P 500 index fund. Even the pros trust it for building wealth. But what keeps the S&P 500 so reliable? It is built on clear rules. A committee selects the 500 companies based on size, trading activity, and stability. They meet every quarter to update the list, adding new giants like Tesla, or removing companies that no longer fit. Each company's influence is based on its market value, so Apple or Microsoft move the index more than a smaller firm. This is called market cap weighting, and it means the biggest companies have the biggest slices of the pie. The S&P 500 has weathered some rough storms. It dropped about 57% during the 2008 financial crisis, 34% in the COVID crash of 2020, and over 50% in the early 2000s dot-com bust. But each time it recovered, sometimes in just over a year, sometimes a bit longer. This resilience is why so many people turn to S&P 500 index funds for the long haul. The rules keep it current, the diversity spreads out risk, and the track record shows that staying invested, even during tough times, has paid off for those who stick with it. Choosing between an S&P 500 ETF and an index mutual fund comes down to how you want to invest. An ETF like VOO trades on stock exchanges all day long. Their prices move up and down in real time, just like any other stock. You can buy or sell an ETF whenever the market is open. And with most brokers, you can even buy fractional shares for just a few dollars. Index mutual funds such as FXAIX work differently. You place your order during the day, but your price is set at the market close. There is no intraday trading, just a single price each day called the net asset value. For people who want to set up automatic recurring investments, mutual funds often make it easy to schedule regular purchases. An ETF tends to be slightly more tax efficient, thanks to the way they handle redemptions behind the scenes. For most beginners, the main difference is whether you want the flexibility to trade anytime or the simplicity of automatic investing at the day's closing price. Opening an account is usually the biggest mental hurdle, but it does not have to be. Fidelity is a favorite for beginners. There is no minimum to get started, the website is clear, and their customer service is top-notch. Vanguard is a classic choice too, known for low fees and a long history of putting investors first. If you want something app-based and simple, Robinhood or Public let you buy fractional shares with just a few taps on your phone. The truth is, any of these will let you invest in the S&P 500 through funds like VOO or FXAIX, and all support dollar cost averaging. Do not overthink the platform. The best one is the one you will actually open and use today. That is the real first step for beginners learning how to invest in the S&P 500. Alex opens the app, types in the ticker VOO, FXAIX, or SPY, and enters a starting amount. Even $50 works. The expense ratios are tiny. VOO charges just 0.03% per year. FXAIX is even lower at 0.015%, and SPY is 0.0945% per year. After linking a bank account, it usually takes 2 or 3 days for the first transfer. Alex reviews the order and taps buy. To make things automatic, Alex sets up a recurring investment every month. That is the dollar cost averaging, putting in the same amount on a schedule, rain or shine. The real trick is to avoid rookie mistakes, like chasing hot stocks, trying to time the market, forgetting fees, or panicking during downturns. The checklist is simple. Pick a fund, check the fee, start small, automate it, and ignore the noise. That is how to start investing in the S&P 500 for beginners, one step at a time. Right now, nearly 80% of the US stock market lives in this one basket. Index fund investing is not a secret club. It is how regular people start building wealth. Do not wait for perfect timing. Start today.